In this section of our course, we're going to cover corporate acquisitions. So corporations often want to buy other corporations, and why do they do that? Well, they might do that to grow. They might do that to create some synergy in their business, or maybe eliminate competition. They want to buy the competition. They might also want to increase supply chain control, so they might buy a supplier to reduce a cost there. It happens all the time, and these acquisitions can be taxable or non-taxable. And we are going to discuss both types in this section. For taxable corporate acquisitions, they can be either asset acquisitions or stock acquisitions. So I can go buy a corporation's assets, all right, and that's a taxable asset acquisition. Of course, the shareholders would have to approve that sale. I could also just go buy a corporation's stock, and that way, if I buy all the stock, I own the whole corporation and everything inside of it. When I buy the stock, I could keep that new subsidiary in existence, or I could liquidate that new subsidiary in a non-taxable transaction. We've covered those before. And then after that transaction, the liquidation transaction, the parent would hold all the new subsidiary's assets. I think it's easy to get lost in this chapter, so I just wanted to graphically show you options. So for a taxable for a taxable acquisition, you can have either an asset acquisition or a stock acquisition. If you choose a stock acquisition, you have three choices after that acquisition. You could just buy the stock and not liquidate. So you would be a parent and you would own the target and you would not liquidate it. The target would be your subsidiary. You could, in number two, you could choose to liquidate that subsidiary into the parent. All right, and that would be a non-taxable liquidation because the parent would own 80% or more in the sub. Or number three, you could make a Section 338 election, and we're going to talk about that in this section. And you would do that if you wanted the target to have basically a stepped up basis. So, when you buy an asset, what you pay for it becomes its basis. If I buy stock, the assets in that corporation, so if I buy all the stock of Target Corporation, the assets inside Target Corporation retain their cost basis. They don't get a step up in basis. So if those assets have appreciated in value, I'm going to buy the stock and I'm going to pay the market value of that stock, which may be higher than the sum of those net assets. So I could make a 338 election to increase the cost basis of those assets. But, as we'll talk about in a minute, that's often not done because it's a very costly election for tax purposes. Okay, so why would I choose a stock acquisition or an asset acquisition? A stock acquisition is usually easier to do. It's simpler. There's no requirement to inform creditors or prepare conveyance documents in a stock acquisition, and it would allow the transfer of non-assignable assets. So this target corporation might have employment contracts, lease contracts, ownership of things that are not transferable. So if we did an asset sale, I would not get to retain those. But in a stock transaction, the target can stay intact, and therefore I can retain those non-assignable assets. But there are some disadvantages of a stock acquisition that would make me maybe want to do an asset acquisition. So in a stock acquisition, the liabilities of the target don't disappear. And those liabilities may be known, right? We know we owe money, but they may be unknown, right? Things can come up after the fact as a result of actions that are happening now that I didn't know about. And so when I buy the stock of the target stays intact, and therefore, as the owner of that target, I'm now responsible for those liabilities. Also, if I buy the stock, I take all the assets. I can't pick and choose. In a stock acquisition, you might have minority shareholders who don't want to sell their stock. If I'm trying to buy 100% of the stock and I have shareholders who don't want to sell their stock, I may have to buy them out, and that may be expensive. And then there's no step up, and we have to meet the requirements of regulatory agencies and local corporate and securities laws. This isn't just a creature of tax law. We also have to satisfy securities law requirements, so it can be complicated. And then finally, no step up in basis. That's what we've talked about before. If I buy the shares of a target. I just buy the shares. My basis in the shares is what I paid, but the basis of those assets inside the corporation stays the same. If I have an asset acquisition, a taxable asset acquisition, the tax treatment of that should feel familiar to you. It's just like all tax treatment, right? When I sell something, I'm going to calculate gain or loss on each asset based on its adjusted basis. So the selling corporation is going to do that. And the character of the gain or loss is going to depend on the type of asset in the selling corporation's hands. So if I'm selling a tractor and it is a capital asset and I sell it for more than its basis, it's going to be a capital gain to the selling corporation. If the selling corporation liquidates, so say the selling corporation sells me, the parent, all its assets, and it's holding cash only now inside the corporation. That selling corporation can just hold that cash for a while. There's going to be a requirement to distribute at some point. Or that selling corporation can liquidate that cash. If it liquidates, then we have to worry about the tax treatment to the selling corporation and then to the shareholders. So the tax treatment to the selling corporation and the recipient shareholders falls under the liquidating distribution rules that we have talked about before. And remember, if it's a meaningful liquidation, we treat it as a sale. If it's not a meaningful liquidation, we treat it as a dividend. Okay, so again, here's another picture for you. This is the stock acquisition. And so the parent wants to buy the target here. And so you can see in this top graphic, the target is owned 50% by A and 50% by B. So they accomplish it like this. A and B each they transfer their T stock to P, and in return, P transfers consideration. It could be cash, it could be assets, it could be debt, whatever. So at the end of that, P has bought out T's shareholders, so P owns 100% of T. T's basis in its assets carries over. So T's basis in its own assets remains the same. And then T's tax attributes remain in T. And then P has a basis in the T shares of what it paid. And then the original T shareholders, A and B, would recognize gain or loss based on what they received, so the amount received from P, and then they would compare that to their adjusted basis in their shares. All right, so we talked about an asset acquisition. I just illustrated a stock acquisition to you. The purchaser buys the stock of the target. The purchaser may or may not liquidate the target into the parent. So back here, T and P may choose to liquidate T into P. So at that point, P would own the assets in T directly. All right, or they could choose not to liquidate, and they could hold it just like this. T could be a sub of P. If the parent chooses not to liquidate, that's a simple transaction, right? The shareholders of the target recognize gain on the sale of their shares, and then the character depends on the type of asset the stock is in their hands. The target corporation recognizes no gain or loss. The basis of the assets remain the same inside the corporation. Because if you think about it, nothing happened inside the target corporation. The only thing that happened is the ownership of Target, but inside nothing has happened. The assets, the liabilities, they all remain the same. The parent, the purchasing corporation's basis in those shares is generally what they paid for it, the sales price of the stock. And then, of course, the disadvantage is there's no step up in basis. We've touched on that a few times. Those assets in the target, they retain their same basis. All right, so that's no liquidation. Now we could choose to liquidate. We could choose for Target to liquidate into the parent. That's going to be a non-taxable transaction if the parent owns 80% or more of the target. We have covered this before. It's covered in section 332 and 337. So the basis of the assets are going to carry over to the parent. Again, that is not that advantageous because usually the basis of those assets is low and the fair market value is high. So later if I want to sell those assets, I'm going to have a big gain. Another possible disadvantage is the parent's basis in the target stock disappears. All right, remember, we had a basis in those T shares of what we paid for them. And if Target has been in business a while, usually the basis in those, the amount we pay for those shares is a lot more than the basis of those assets. So when that basis disappears, that's a disadvantage if I paid significantly more than the asset basis. However, if I paid less than the aggregate adjusted basis of the assets, that excess is going to be included in the carryover basis. So that's advantageous to me. Okay, so that's a liquidation. Now I have an option. I could make a Section 338 deemed sale election. I would do this to increase the basis in the assets. All right, that it would treat a stock acquisition like an asset acquisition. You would keep the new target alive and you would liquidate into the new target. Okay, so in a 338 election, if the purchasing corporation purchases 80% or more of the stock of the target corporation within 12 months or less, it may elect to treat the target as having sold all its assets for the fair market value in a single transaction to a new target. Okay, so we must purchase 80% controlling interest during a 12-month period. It can't be a 13-month, it can't be a 15-month, it has to happen within 12 months. I have to make the election no later than the 15th day of the 9th month, beginning after the month in which the acquisition date occurs. And then the day after the deemed sale, Target is reincarnated as a new corporation with no earnings and profits or other tax attributes. So basically, old Target goes away, new Target comes into existence. New Target is deemed to have Old Target is deemed to have sold its assets to new Target for their fair market value. So it essentially treats a stock acquisition as an asset acquisition, but it usually has a huge tax cost. So we don't usually do it because all that sale, if the assets have appreciated in value, that deemed sale is going to result in a huge gain. All right, and then of course you're going to pay tax on that gain. So why does this exist if it's generally not a good deal and it's virtually not used anymore? Well, it exists because it was enacted when liquidating distributions and sales didn't trigger corporate level taxation. They only triggered shareholder level taxation. So there was only one layer of tax. And so it was somewhat useful then because you could get a step up in basis at a reduced tax cost, but not today. So since it is not used as much today, we're not going to dive into the details and the allocations of basis and all of that in your text. So you can skim that if you want. We're not going to focus on that too much as it's not very useful today.